Hej och varmt välkommen till Global Gains-podden. Mitt namn är Karl-Hans och vid min sida sitter min kollega Per Ståhl. Hej!
Hej! Idag ska vi prata amerikanska småbolag.
Precis, det ska vi göra. Vi ska träffa Geoff Davies som är Head of US Equities på BNP Paribas. Vi ska prata lite om amerikanska small- och midcap-marknaden och vilka sektorer som han tycker är mest intressanta. Och varför kanske också han tror att det kan vara en vändning på gång i marknaden eller small caps-bolag. Vi får se.
Welcome.
Great, thank you. Happy to be here today. Thanks for having me.
We are very curious about the US small cap segment. US small caps are now trading at one of the deepest discounts to large caps. Do you see it's like a buying opportunity, or could it be even a bigger discount, do you think?
Yeah, it's a very interesting time. And yet, to your point, we have had quite a outperformance by the large caps, particularly the biggest companies in the S&P 500 or the Mag 7, those big tech companies. They've outperformed materially and for good reason, right? They've had outstanding earnings growth. They're fantastic businesses with diversified businesses, high margins, strong free cash flow, great revenue growth. And their growth has significantly outpaced the small cap universe. So you've seen those valuations diverge materially to your point where the Russell 2000 or small cap stocks are trading at one of the biggest discounts in history. So it's an interesting time. From our perspective, we do see signs of that and signals and catalysts that would narrow that gap where small cap valuations catch up to large cap. And a lot of it's going to be predicated on the narrowing of the earnings growth gap. We see large cap, particularly the largest companies in the world, they've been fantastic companies. They're going to continue to grow, but it's going to decelerate a little bit. And at the same time, you're going to have the small caps that are coming out of a very slow earnings period. In fact, in many cases, negative earnings growth. They're going to be coming positive in our view. The timing is still tough. It's tough to time exactly when this will occur, but I can talk about some of the reasons why we think earnings are going to be accelerating and growing in the next couple of years and narrowing that gap with large caps. And I guess just to back up on the small caps, you do get a lot more exposure to non-tech areas. So you're getting a lot of exposure to companies in the industrial sector, financials, and some of the more cyclical areas in a small cap benchmark than you would in the S&P or the NASDAQ, where you have a much more heavier tech exposure. So as the economy and domestic investment improves, it'll be more concentrated in the small cap names or the small cap benchmarks, that have that diversified exposure. And so we expect a broadening of growth beyond just the small cap names. And beyond the large caps. And one of the catalysts we see is the fiscal stimulus that's ahead of us. You know, we had what the administration has called the big beautiful bill that went through Congress and had a number of fiscally stimulative measures in it. For one, there was a measure that provided tax certainty for both consumers and enterprises. Two, there were some tax benefits that we think will cause more investment in domestic infrastructure and manufacturing. So now companies get an incentive on the tax side for putting money to work in new projects or in capital equipment. We think that'll cause the incremental project to get started. The other piece of it is deregulation, we think helps small caps. I mean, clearly the administration wants to be able to move faster on permitting of projects for commercial real estate or housing or energy projects. And that's going to help the domestic growth rate in those companies that are levered to domestic investment. Same thing on the financial side. A deregulation of some of the banking requirements will allow for more liquidity, allow for more lending into the markets. You know, in the last couple of years, some banks have pulled back a little bit and not lent as much. And now with slightly an easing of regulations in a strong underlying economy, the banks will be providing significant liquidity and allow those small caps to have to be able to shop for loans and get a better rate and have just more access to capital. All good things. And we're starting to see some of those investments already started on the domestic front in terms of, we've seen some big tech companies and some big semiconductors announce plants and planned investment in the U.S. And the same thing from the big pharmaceutical companies and even some of the car companies. So a lot of reasons to like the investment theme. And another thing that's been just a structural theme for small caps in our view is the reshoring theme. Mm-hmm. A lot of investment has come back from outsourcing to low-cost nations. And after COVID, when you saw the disruptions from supply chains, every company in the country could not get their goods to the supermarket or their stores or their end consumers. So they opted to bring back manufacturing. So that's going to cause a multi-year increase in bringing supply chain and investment back to the United States. And that's going to help any company that's levered to small caps and domestic activity.
Do you see strength to have a small cap fund because you can targeting certain areas in the US, reshoring, or if it's AI or local banks?
Yeah, I think it's a great question because in small cap, you can get a bank, for instance, that's levered to a local market. You can get a bank that is levered to the Southeast, where there's new plants going in from automakers that have announced plants in states in the Southeast, and there's just going to be more job growth there, and there's going to be more growth in terms of population as well that allows them to bank more customers. And we've seen demographic shifts where a lot of people are moving since COVID. It's accelerated a little bit to Southeast regions. So you can get that exposure through select companies instead of buying those large caps that are levered to the entire nation. You can get a small cap companies that's levered to any one market and capture that growth that you're seeing from either the reshoring element or just demographic shifts.
Do you see any hotspots? I mean, I've been to Austin in Texas 2 years ago. It was so dynamic. It was vibrating, I think, and it's fast-growing city with everything. They were talking everything from AI, chip, whatever.
Yes, I think there are some really hot markets. I mean, I think Austin is one, as you alluded to. A lot of the technology from Silicon Valley had moved to Austin. We're seeing a little bit of that move back, to be honest. There's San Francisco is regaining some strength again with AI and seeing more AI startups and more business out in San Francisco, which is great. But Austin is still a very strong market. Another very healthy, vibrant market that's grown in the Southeast over time is Nashville, Tennessee. Mm-hmm. So Nashville is a growing market in the Southeast where there's a lot of interest in starting up new businesses. There's a lot going on culturally as well there. So that's been a big market. But Texas, on the state level, Texas and Florida are markets where you're seeing a lot of growth just because of the population that's moving in there and the business, the laws they have towards businesses and a slightly lower regulation makes it easier to do business there.
Is banking the easiest way to do a local play, or do you do any other sectors where you can target a specific growth?
I would say banks are one way to do it. Another way is through real estate and real estate investment trusts. So you have commercial real estate plays that can be local, whether you're looking for, we own an office REIT that invests in premier office space in what they call the Smile. So that runs from the southwest of the United States down to Texas, then back up to the southeast. So they have exposure to more the growthier markets in the United States. And they do that with Class A properties, with high amenitized properties that are really gaining share since COVID. So another trend you've seen since COVID on the office front is clearly we've gotten into a hybrid environment. So people are coming into the office less frequently, but they're also choosing to upgrade their office space. So in the real estate space, in the office particularly, you want to make sure you have those properties that are not just in a growing demographic, but also the highest quality, most amenitized businesses, because you're going to get the highest rents and you're going to get the best occupancy.
When you look at the overall market for small and mid cap in the US, what trends do you see right now? I mean, it resembles a little bit 2021. I mean, if you look at the unprofitable small caps has been moving lately.
There's no doubt. And we've seen a little bit of pockets of speculation within the small cap market, particularly since August of this year. We've seen non-profitable companies in the Russell 2000 outperform profitable companies in the Russell 2000. So you're seeing some excess speculation. And a lot of this are from those companies that are lower profitability and exposed to some of those tangentially exposed AI names, not necessarily the core AI infrastructure names that are getting revenues or the semiconductor names that are winning and generating profits, but some of those longer dated companies that have growth horizons well out in the future that at this point are probably more hope than, unfortunately, substance at this point. And some of those categories would include some investments levered to space, some investments levered to quantum computing. Some elements of the power trade also have gotten a little frothy in terms of how far they've gone. Also, some elements of the cryptocurrency trade have also gotten very heavy. And I'd even throw some of the drone companies into that bucket as being exuberantly priced right now. So they have had a very good run, but you have to be careful because it's possible there's a little bit of speculation at this point and a little bit too much in those prices.
What sectors do you prefer at the moment?
One that we've liked is healthcare. It's just such a dynamic sector, such an innovative sector. There's so much growth there. And from a small cap perspective, you can find a lot of idiosyncratic ideas, just ideas that are very differentiated products, differentiated services. So particularly in the biotech and medtech space, we're finding great ideas. In biotech, there's clearly a need for innovation and finding solutions to large unmet clinical needs out there. And, the innovation just hasn't stopped. People are continuing to find cures for rare diseases. And same thing on the med tech side. These are big markets, and not every type of med tech instrument is everything can be improved. But an element within healthcare that's very interesting to us, particularly on the biotech side, is on the M&A side. We've been in a period where mergers and acquisitions have gone down since 2021. And we're in a period now where we think that that's going to tick up, probably materially, given the interest rates have come down, the economic environment has been very resilient, and there's a huge pipeline of deals to come, both from on the PE side and from corporates that have been talking about what the next deal that they need to get done for years now and just haven't been able to get it across the finish line. But biotech in particular is interesting because you have these large pharmaceutical companies that have very big patent cliffs. So they're going to lose a lot of drugs going off patent, and that's a lot of revenues. That's hundreds of $billions of revenues that are going to go off patent by 2030. And they have to replace that revenue stream. One avenue is going to be internal R&D. They're going to do their own development of drugs, but it's not going to be enough. They're going to have to go out and they're going to acquire. And they're going to acquire a number of small cap biotech companies. It's not going to be just one. Then they have the cash to do it. They have great balance sheets. They have a lot of cash. They can go into the debt markets. I mean, this is hundreds of billions of dollars sitting on available for large cap pharma to do deals. So it's an area that's very interesting to us is the healthcare side.
Do you hoping for lots of buyouts? The companies you own, that they will be acquired by the large cap healthcare companies, or do you prefer to just have them in your portfolio for riding the performance.
Yeah, so it's always in the back of our minds. We always look for a good deal and a good takeout premium for biotech. We always have a fundamental case for why we would own the company even without a takeout. But we're always talking to the large cap pharma companies too, figuring out what types of biotechs they'd be interested in from an M&A perspective. So we've actually had 2 of our companies acquired this year, and we'd expect more in 2026.
What's the average in your fund of companies that disappear to get
So
bought up?
we've had 6 this year.
Is that on average what you usually have? Or
I would say 6 is a good average. Okay. I think I wouldn't be surprised to see that tick up a little bit in the years to come, just given the environment we're in. And last year was a little lower because it was a slower environment.
Is that good for you? Does it give you good alpha for the fund?
Particularly biotech. Yes, that it does give great alpha because biotech premiums on the takeouts can be 50 to 100%. So in one day, you can have a stock up 50 or 100% on the biotech side. Most other industries, it's more normal to get a 10 to 30% premium. But biotech is an area where you can really get some nice alpha very quick if you get the fundamentals right, and you have to get lucky.
Wow, that's something for Carl. I see now he's interested in to get some alpha from the biotech companies. But I think it's not very often that we have a portfolio manager from Boston. To be honest, we have to ask you about AI. AI has dominating the headlines. The big mega caps now talking about an AI bubble. Do you find lots of the AI story in smaller companies?
Yeah, that's another good question. I think I would agree. There are a lot of opportunities within small cap to ride that AI wave. I think a lot of the initial spend on AI was for some of the largest semiconductor companies in the world that are generating and selling GPUs. And that's caught up a lot of the initial capital spending that you've seen from these big hyperscalers, the biggest hyperscalers in the world. But it's also, as we build out these data centers in the US, there's a lot of AI infrastructure plays down market cap that are very interesting. There are companies that are providing NAND storage. As you have AI, you're going to have more bandwidth, more data being stored. And the same thing there's a optical networking company that connects data centers. Clearly, you're going to need faster data centers that can transmit more data between on the data center campuses as they grow. You have asset managers that also private equity asset managers that are only catering to digital investments. And there's industrials that are doing liquid cooling within data centers. So there's a lot of different ways to play the AI trade within small cap. So it's not just a large cap theme.
Is that the big theme in your portfolio, AI, or the companies you were talking about, cooling companies or optic companies?
Yeah, it is. We have good exposure to the underlying AI theme. We are very cognizant of valuations. And we're also very cognizant of portfolio construction and portfolio risk. So we don't want to go overweight any one theme too much. And particularly after the run it's had for a number of these names, we're very active in managing those position sizes and trimming them back because it's had a very healthy run for a lot of these names. And we're recycling those AI winners into actually some of the software losers that have been potentially, at least seen to be potentially disrupted by software. Being disrupted by AI. So those stocks that have sold off, we'll take those winners in AI and recycle them into some of our losers to keep that portfolio balance and keep that upside still available across the entire portfolio.
A question about the US real estate market. The Fed has started to cut interest rate. Do you see any improvements in the real estate market?
Yeah, I'd say, a couple of years ago, I would say definitely during the regional bank crisis, there was a lot of consternation about the value of real estate sitting on bank balance sheets and just generally in the market, particularly after COVID and the shift in the way people work, right? Particularly in office. Office was the area of greatest concern because people were working in a hybrid environment, occupancies were going down, and the value of real estate was also going down. And the value of real estate did go down in commercial real estate, particularly in select big cities where you saw the less job growth and less people going into the office. San Francisco is an obvious one that got hit hard after the pandemic when occupancies went down and they had a lot of large, multi-story office towers that were very expensive and built recently. And they had a lot of debt on them. So they grabbed a lot of headlines. Some of the larger banks and some of the commercial mortgage-backed securities had to take losses on some big towers. But at this point, it feels like, knock on wood, that we're through the worst of it. And we're actually seeing transaction activity increase. We're seeing prices trough and some ticking up in some areas. So I think that while there will still be some losses, I'm sure, on the as we get through the bottom here, the commercial real estate environment's looking much better than it did right after COVID and a couple of years ago, with more activity and better pricing.
How are you exposed to the U.S. Real estate market at the moment?
Yeah, so we in our REIT exposure, we do have a diversified approach. So we do have an office REIT that, again, is catered to the Southeast. And that was sort of our value play from a couple of years ago, which we've held on to. And we have a lodging REIT. This year has been a difficult year for lodging as consumers have traveled a little less. So we've seen earnings trickle down for our lodging REIT. We also have a healthcare REIT that's very relatively defensive, as they own medical office buildings, which are structurally have lower earnings variability, just given people go to the doctors in good and bad times. And then we have a commercial real estate broker, which has done very well because of the higher transaction activity that I alluded to. There's more leasing going on across the board. There's also more buys and sells of commercial real estate properties, which really leads to more activity and better revenues for a commercial real estate broker.
You've been traveling in Europe now for almost a week. What does people ask you in Europe compared with the US?
It's interesting. Yeah, I'd say there's a lot of interest in small cap right now. That's one thing that's very clear, in that, after a period in April when it was very slow and we weren't getting a lot of calls through April, May, June, July, and there wasn't a lot of interest in companies levered to the United States, I'd say in September and October, interest has really picked up. And clearly on this trip, there's been a lot of interest in understanding small caps and trying to look for those catalysts for when it's going to sustainably outperform. So I think that is probably the biggest takeaway. I think another one is just there is some concern about the AI trade and whether that has legs. I mean, there are, in our view, there's some warning signs, but we think that the companies, the hyperscalers that are driving a lot of the spending, they're extraordinarily healthy, diversified companies that are spending within free cash flow. So that's a very positive thing. And we think they're rational, and the pricing and valuation is not as extreme as in the .com era. And I think the things we're watching internally are the circular relationships between many of the players. I think that's something we want to make sure we understand and watch how that evolves as they're selling to one another and financing one another. And also just the opaqueness of any debt raising and just having a better understanding and making sure we understand the debt that's being raised to finance these things. But it seems like, revenues are still in the right trajectory. They're starting to monetize investments from AI. So, it seems like, we may be on the path to a bubble, but perhaps we're not there yet.
The weak dollar, how does that affect the US small cap companies?
Yeah, I mean, the weak dollar, they're mostly...
Weaker dollar.
Yeah, and I'd say the dollar's been it's been really a tough ride so far this year. It's hard to predict where it's going to go from here. It's been not shockingly gone down, but it's interesting since sort of April, at least on U.S. assets, a lot of people were selling U.S. assets. Outside the U.S., people have continued to buy treasuries again when it's picked up, which has surprised me a little bit. And same with U.S. assets, right? I think it's partly to do with U.S. earnings growth being very resilient and the economy being very resilient. So I think the economy matters more and the underlying growth rates of these companies matter more. And so far, it's been relatively durable and surprising to the upside.
But it's also cheaper to produce in the US, and that would probably benefit the mid and small cap companies in the long run.
Yeah, very true. I think a lot of these companies, the vast majority of their revenues are tied to the US, but so are the vast majority of their costs. So obviously having that cost advantage on the dollar is beneficial to a domestically oriented company.
In 1 year time, do you think the discount for the small cap will be larger than today or get smaller?
You're putting me on the spot, but I'm going to say that it narrows. I think the discount to large caps narrows over the next year.
If it doesn't narrow?
Well, I think if it narrows more, you might have more M&A takeouts, more buyouts, more leverage from the large cap companies to go in and buy some of these small cap companies because they're well positioned to do it now. They have both the cash to do it and the multiple, right? Their valuation is so much higher. It makes it easier to buy. So, if they were down, the most likely reason they would be down is if there's some kind of major economic recession. Yeah. That would be the most likely scenario. Something that's not foreseen today. That would be unfortunately a cataclysmic event that would take down the markets.
But the most assets would be down in that scenario, I think. So anyway, so it's a good opportunity to probably. Yeah,
it's could always. Be, yeah. I think for the long term, it is. It's always very difficult to time these things, but I think the tailwinds are lining up, both structural and cyclical, for small caps to be a decent place to be.
That's a good positive ending. Yeah. Thank you very much.
No, thank you guys. I was happy to be here.
Och glöm inte heller att följa Global Gains på globalgains.se, så får ni vårt nyhetsbrev cirka 2 gånger i veckan. Gratis. Vi vill påminna om att allt som diskuteras i denna podcast är gästernas och våra egna åsikter. Ingen del av samtalet ska betraktas som investeringsråd. Gör alltid din egen analys eller rådgör med en kvalificerad finansiell rådgivare innan du tar investeringsbeslut.